Yeah, hello, welcome back to the channel. Today, you added tax part 61. And before we begin with today's contents, there is something special because some days ago I found out after a look on the list of all my videos on my YouTube channel that today's video is video number 250. And then I thought perhaps this might be a special occasion to celebrate this a bit. And then I thought about it, came to the conclusion, no, it's not. So let's just begin with the regular stuff as always. Value-added tax, that's a topic where you always have to be very well trained, and that's the explanation why after our chapter on cross-border deliveries within the EU, there are so many exercise cases. This is now exercise case 24 in value-added tax, and it's a small one. I hope so, at least. C from Chemnitz, that's a town in Germany, orders a machine from a producer in Paris, France, for a price of 300,000. And now C doesn't rely on others, so he goes to Paris, naturally, probably not on foot, but with a truck or so, and receives the machine there, then carries it over the border to his factory in Chemnitz, Germany, where he uses it. And furthermore, another event, C ordered a new business car from a trader in Paris for a price of 30,000. So what are we going to do? Well, the best reason or the best principle to begin is always let's begin at the beginning. So what's the beginning? To make a small sketch, what's happening here? The first event is P from Paris sells evidently a machine to C in Germany. Now C goes there with his truck and carries the machine from Paris to Chemnitz. Now, as you know, it doesn't matter who carries out the transport usually. So the decisive thing is just the good goes from Paris to Chemnitz during that transaction, so it crosses an EU internal border. That means the rules for EU deliveries have to be applied, have to be tested here. So let's review them. That was a three-step testing scheme. First, if the customer is an entrepreneur, the customer should pay the tax to the country of destination. If that's not possible, then we have step 2. In that case, the deliverer must pay to the country of destination, and if even that is not realistically possible, then the deliverer has to pay the tax in the country of origin. Now, step number 1, that would be here, the customer is an entrepreneur, and the answer is yes, he is. See, from Chemnitz has a factory and buys a machine for his factory. So that's clearly an intra-community acquisition for the customer, and it will be an intra-community delivery in the country of origin for the supplier. So let's find our formal and correct answers. Here in this exercise case, we will deal with both the customer and the supplier. If you really have an exam, you would have to find out what you are asked, and if you don't know what you are asked, the best recommendation is then always give the truth, the complete truth, and nothing but the truth. Then the truth of any examiner will be contained in your truth. Well, so let's begin with the treatment of the customer C from Chemnitz. We have to test first if it's a taxable transaction, and taxability for a customer is one number 5. Is it an inter-community acquisition? And we have to look here on 1A. You remember that rule probably, or if not, or in case you don't do, we have a look at it before we go on. So here it is, 1A defines the intra-community acquisition of goods, as we have seen in an earlier video, as or by 3 conditions which must be fulfilled. First, the good gets from the customs territory, so the VAT inland of one member state, into the inland of another member state. the purchaser is an entrepreneur which acquires the good for his enterprise, or a juridical person who is not an entrepreneur or does not acquire for its enterprise. And by the way, there are many nice typing mistakes which I see now for the first time after years, however, don't matter. And please don't worry about it. And the delivery to the acquirer was made by an entrepreneur who is considered as entrepreneur for VAT, so who is not a small entrepreneur. Well, I think in our case we will find out that that is the case. And so let's have a look to the case data again and fill out our answers. So 1A number 1 was the good goes from one EU state to the other. That was correct. France to Germany. The acquirer was an entrepreneur. Yes. C from Chemnitz has a factory and buys for his factory. So that's definitively fulfilled. 1A number 3, the delivery is an entrepreneur and not a small entrepreneur. So the transaction is relevant for value-added tax at all. So it is an intra-community acquisition. Now the next condition which has to be fulfilled in one number 5 is that intra-community acquisition must be in the inland. So we need the place of the acquisition, and we test this in 3D. And just to remember that, we have a look. So here it is again. 3D says what we expected, or what we expect if we remember the system of value-added tax. Goods should always be taxable in the country where they are consumed, where the consume takes place. That was the basic principle of all value-added tax and indirect taxes, the principle of taxation in the country of destination. So it can't surprise us if we see in 3D first sentence that the intra-community acquisition is allocated or taxed or seen as done in the territory of that member state in which the good is located at the end of the transport. So nothing surprising, just the confirmation of what we already suspected here in the text of the law. However, for the technical procedures, you remember probably that the acquirer had to give or to communicate to the deliverer a value-added tax identification number, and then from the country of the deliverer there is an automatic information exchange with the country of destination, which is then informed about that acquisition so that the acquirer cannot forget it to declare this acquisition. And if you now not use the VAT identification number of the country of origin, you bring confusion into the whole system, and for that reason we have here a kind of punishment rule, because if you use the VAT identification number issued from another country than the right one under sentence 1, you will be additionally taxable in that country where the number was taken from. So then you have to pay the acquisition tax legally in both countries until you can prove to the country of the number that you correctly fulfilled your taxation duties in the country of destination. Well, so a bit complicated, however, an understandable logic behind it. So we have to test now our case here under the aspect of first, where did the good end up? And second, was the number of the right country used? So let's have a look again to our text. As you will see, if you look to the small little lines here in our case description, we know here that the country of destination is evidently Germany, because the other machine ends up. So the place of acquisition under sentence 1 is Chemnitz. Now, it's reasonable to suppose that a German customer has at least one German value-added tax identification number, and there is no conceivable reason to suspect that he used any other different number from the German one. So sentence 2 does not lead to an additional place of acquisition in another country, so it will be taxable in Germany and only there. Paragraph 4b, the exemption does not apply. You remember that was a very small rule. It has only 4 entries and it nearly never applies. So you can usually, at least guess that 4b does not apply and that therefore the acquisition will usually be fully liable to tax. Tax base is the net amount, naturally, as always. All what the supplier gets minus the VAT amount which is included therein. However, here the customer C pays the VAT to the fiscal office himself, so the VAT amount cannot be included in that amount, so 300,000 must be a net amount. Well, now tax rate and the tax, that's nothing, not a big affair. 12.1 USCG in Germany says it's 19% if we have no proof that it's 7%, and we don't have any proof for that, so the tax is 57,000. The formal aspects are the taxpayer is C, the customer, the acquirer. They can be seen in 13A1 number 2. We already had a look on that rule in several other cases, so I hope you know where to look it up. And the arisal of the tax, or called tax point, so the point of time when the tax comes into existence, is defined under 13.1. Here it's number 6, and that rule says the tax arises when the invoice is issued, or at latest at the end of the first full calendar month after the delivery was made. Now we don't have any time information here, no data on the time when it happened, so we can only say that in general. Invoicing details or rules, well, an acquirer doesn't write an invoice usually, so that's nothing. Declaration duties, that's also nothing peculiar. The acquirer will have to fill out his regular tax declaration, and there is one line where you have to declare your intra-community acquisitions and pay the tax for it. Special things which do not occur in the usual testing scheme do not happen here. And the last remark is input tax claims. Yes, the input tax can be claimed back under 15.1 number 3, so the acquisition tax 57 is paid, and within the same tax declaration a few lines lower or below, it is then directly reclaimed as input tax. So that underlines that for most cases, this whole game with the acquisition tax is usually not about the money, but that the goods which vanish from the books of the deliverer without being taxed must show up in the bookkeeping of the acquirer. That's made sure here, so that later they cannot vanish completely untaxed into consumed, and that is evidently the most vital function of all that acquisition tax. Okay, now just for the sake of completeness, how will the deliverer be treated in Paris? Or the deliverer in Paris be treated better? He is the deliverer, so for him we have to test 1.1 number 1, not number 5, because sellers don't buy, they sell, so they can't be acquirers, they can only be sellers, number 1. So delivery, yes, we have a delivery 3, number 3, paragraph 1 says, the position like an owner in a tangible good is shifted to somebody else, so that's it. The place of delivery is if the good is moved, and it's moved here, there where the movement of the good towards the customer begins. That's in Paris, that's in France. So the other criteria are also fulfilled: entrepreneur, acting as such, and for consideration. So we have a transaction which is not taxable in Germany because Paris is not in the German inland. However, France, as a new state, has a system of VAT rules which are identical mostly to German VAT rules due to the common EU law background. So there will be in France a rule which is a parallel, which has the same contents and 1 number 1. However, they will call it differently. So 1 number 1 will not be the correct reference in the French rule. However, 1 number 1 of the German law says, and we can rely on that, that will be taxable in France under their rules. So by analogy, we can conclude that. Now, is it tax-free? And there we also know the rules on intra-community deliveries are also identical in all states of the European Union. So we can test it by analogy of 6a. 6a number 1, the good goes from one EU country to another. Yes, that's true from France to Germany. Number 2, the buyer is an entrepreneur and acts as such. That's true. C, buys a machine for his production site. Number 3, the buyer is also subject to acquisition tax in Germany. And number 4, the buyer uses his VAT number during the transaction. That can be supposed if C is not a complete idiot. So then we have an intra-community delivery, and that means it is tax-free under the condition that it has been correctly declared by the deliverer in the recapitulative statement, so that he passed on to his fisc in France the VAT identification number of buyer C in Germany plus the net amount for which he sold that good, so that the German fiscal administration gets the information that there was an intra-community acquisition made by C from France and can check if it has been properly treated in books. The tax base is again the net amount, 300,000, so there is no tax now. And by the way, paragraph 10 is again by analogy of the German rules. Naturally, the French rule will have a different number, and it will even be in French, because French people use French language, at least in all their official documents. You know, French is the language of the Republic. Yeah, taxpayer is the deliverer from France. Now, no tax has to be paid. However, the taxpayer is also the guy who's responsible for handing in the tax declaration, bringing the proofs for the tax exemption, and in this sense, the taxpayer is naturally the deliverer. That can be concluded by analogy from 13A1 number 2, by the way. All the rest of formalities, and this one even, will be regulated under French law. Peculiarities, something special which the usual testing scheme does not contain. Yes, with inter-community deliveries, you know there has always to be made that recapitulative statement where you have to communicate the VAT number of your customer and the net amount which you delivered cross-border to them. What we also should remark in our solution is that although the intra-community delivery is tax-free for the deliverer, nevertheless the deliverer keeps the right to input tax for all his raw materials, services, and so on connected with this transaction. That can be seen under 15.3 number 1 of the USDG. Okay, so now second half of the transactions or of the case. That was completely different. A new car is purchased from Paris. It's a business car. So we have the following contract relationship. We have a car trader. We have C in Germany, and C buys a car, and that car goes during the transaction from Paris to Germany, and it crosses an EU internal border. So we have again to think about the rules for intra-community or cross-border cases in the EU. You probably now remember with a shock that there was a special rule for new vehicles sold across the border in the EU. However, these rules for new vehicles only apply as far as the desired outcome, that is taxation in the country of destination, in case of a car always by the acquirer, cannot be achieved by using the regular rules. And so one usually first tests the regular rules, and only if they do not lead to taxation in the hands of the acquirer. Then we go over to the application of these special rules. Here we can directly see C is an entrepreneur. There will be inter-community acquisition rules applicable to him. So we don't need any special rules to establish the tax payment by customer C in Germany. Special rules are only needed if a private customer buys a new car from France. That only has an additional information. So we test again 1.1 number 5, inter-community acquisition, and the answer is 1b. Does not apply. That's a special rule for new vehicles if the customer is not an entrepreneur. And so 1a is to be tested in advance. Number 1, yeah, is fulfilled. Car goes from one EU state to another. Number 2, customer is an entrepreneur. Number 3, the provider, the seller, the vendor, however you call him, is an entrepreneur and not a small entrepreneur. Yes, he's a car trader, so that's clearly fulfilled. And is the place of acquisition in the inland? Yes, that's Chemnitz. 3D sentence 2 leads to no other result because C, if he uses a VAT identification number, will use his German one. So it's taxable in Germany. 4b does not apply, so it's fully taxable. And net amount is the tax base, tax rate, and tax will be 19%, so 5.7. The taxpayer will be the buyer, as usual in these cases, tax arisal when the invoice is issued. You remember that from the last situation. So it's very often routine what you have in these cases. You should have already noticed that. However, always with routine, you have always to be cautious. There might arise a detail where there is a difference, and then everybody sees that you are just praying down things as usual without thinking. So you must always be cautious if it really, the routine statement really applies here too. And the input tax claim is there for our buyer because it's a business car which he buys for his business. So he uses it for business and gets the input tax. We can then additionally look again for the treatment of the delivery in France. Taxability, here we have number 1, it's a delivery. The place is where the movement of the good begins, that's France. So it's taxable not in Germany but in France under number 1, or better, the French parallel to that rule. Tax exemption, intra-community delivery has to be tested. It will, in all probability, be fulfilled. So let's check all the numbers. The good goes to Germany, comes from France, so crosses an EU border. The customer is an entrepreneur. It's subject to acquisition tax in the hands of the customer. In Germany, see above, we tested this already, and the customer uses his VAT identification number during the transaction. I think we can reasonably assume this if C is not a complete idiot. The case doesn't give us any hint to the contrary, so we assume that all formalities have been fulfilled correctly. So it is an intra-community delivery, so it's tax-free if the recapitulative statement is correctly issued by the French deliverer. And it's tax-free for him, not for the acquirer, because the acquisition in Germany was a different movie. We have already tested it. There it was liable to tax. The tax exemption for the deliverer is only granted because of the tax payment by the acquirer. So we have to keep these two sides apart. And the tax base for the recapitulative statement is here 30,000, the net amount again. So there is no tax. The taxpayer, so the guy who has to fulfill all the tax obligations, here not a payment, but the tax declaration and the recapitulative statement, that's the car trader. Arisal is according to French law, and all the rest is according to French law. We don't see any peculiar aspects apart from the duty to fill out the recapitulative statement electronically so that the data can automatically pass over to Germany. And in spite of the tax exemption, the deliverer keeps the right to deduct his own input taxes from purchase of a car or marketing service relating to the transaction or whatever it might be. And so that is also complete. So that was our case for today. I thank you for watching and wish you the very best and hope to see you soon again on this channel to talk about another exercise case, or after a while even about some additional rules which you do not yet know. Thanks and goodbye.